Hello, everyone. My name is Mark Bautis. Thank you for attending the presentation today. For today's webinar, we're going to look at the year in review, where we'll cover what happened in 2021 and some planning ideas for 2022 and beyond. So I'm the wealth manager, founder of Bautis Financial. We're a financial advising firm located in Montclair. We host these educational webinars every couple of weeks. If you want to see any previous webinars that we've hosted, you can go to bautisfinancial.com/learning center, or you can see or sign up for any upcoming webinars that we're hosting. Our next one will be in a couple of weeks, where we'll do a financial fitness checkup and show you how to do one of those. Okay, so I have my colleague Kira Makasi on as well. If anyone has any questions, feel free to put them in the chat or the Q&A, and we'll stop periodically throughout the webinar to see if there are any questions. This is one of our longer presentations. It's also one of the more popular ones that we've done. Especially with everything going on in the economy and the market. So I think this one will have some information that people will find interesting. We're going to touch on a couple important topics, including like I mentioned, what happened in 2021, but we'll mostly focus on this year and what's going on now and what we can expect to happen going forward. So we'll take some forecast projections, Goldman Sachs, LPL, Morgan Stanley, and really we'll look at 10 things to look for in 2022 and also 9 predictions for this year as well. So just as a quick disclaimer that this webinar is for educational purposes only, and before you make any financial decisions, consult with your financial professional. All right, so this is actually the one slide that we have that looks back at 2021. Since it happened, we obviously want to know what happened, but we'll focus mostly on this year going forward. But here we can see where the different asset classes or indexes closed for the year. And you see the S&P 500 at the top, and it's the US large cap stocks continued their bull run. But one interesting from this slide is that it was the first year in a while that NASDAQ didn't have the highest return out of all these different asset classes. So we'll talk a little bit about that, why that was, and then what we can look for, starting in 2022. Okay, so first we'll start off with the economic outlook, market pulse, and we'll briefly discuss some economic themes as well as asset class views and forecasts. All right, so according to Goldman Sachs, growth, it's high, but it's headed at its trend level. So global growth is expected to rise about 4.5% in 2022. And that you can see under the Goldman, the GS column, the 2022 GS column there. But also in the chart above, you'll see that they estimate US growth to reduce to 3.9% in 2022 and 2.1% in 2023. So I know actually some growth numbers just came out today, which were actually pretty good, but Goldman Sachs sees growth slowing down slightly. However, what it does is it sees European growth expecting to rise to 4.4% in 2022 and similar to the US decline in 2023. So it believes that developed markets, which are that US and Euro area, which you're looking at on that table, they think that they'll reaccelerate due to continued medical improvements, that the economic reopening, which hopefully happens and stays reopened. They think there'll be some pent up spending, so they'll think there'll be some consumer spending, some consumption, and then as well as some inventory rebuilding. So those are the themes they think where we'll see some reacceleration of the economy. Now, emerging markets. So emerging markets, if we looked at that 2021 chart, they were at the bottom with actually a negative return for 2021. And they still think growth trends will become even more disparate. They think they'll be below consensus growth for China in 2022. There's some issues over in China with the property markets and their macroeconomic policy. They see only easing modestly. Brazil, another emerging markets economy, they're expecting them to decline significantly in 2022 due to inflation, which we'll talk a lot about inflation, and their recent tightening of monetary policy that they're going through, similar to here, to try and rein in inflation. India was hit hard by the Delta variant, but they believe their recovery will actually lead to growth of roughly 9% in 2022. So a positive outlook on India. The latest CPI data indicates that inflation is currently about 6.8% on a year-over-year basis. That's actually the highest it's been over the past 39 years. So that we're going to spend a lot of time on inflation. And I think that's a lot what's driving what's going on in the economy and the markets right now. And just on that 6.8% inflation, I've talked recently about how investors may want to consider I bonds for their portfolio. So like every investment, there's pros and cons, but I bonds are directly tied to the interest that I bonds pay are directly tied to the inflation rate. So right now they are paying a good interest compared to some other fixed income options that are out there. All right. So on this chart, we can see just how dramatic inflation has been since the beginning of the Fed's bond buying program in 2020. The blue line represents the personal consumption expenditure index, which is that's the Fed's preferred method of tracking inflation because it accounts for short-term changes in consumer spending, and it's taken by business surveys. The gray areas represent recession periods over that time period. So the Federal Reserve set the stage in 2021 for a series of rate increases beginning around March or April of this year, and they confirmed that in their meeting this week. And at the end of 2021, most central banks penciled in at least 0.75% rate increases in 2022, and I think that's a big reason for why we're seeing some jitters in the markets now. Goldman Sachs estimates that core PCE inflation will remain above 3% as the Fed's taper concludes. There's been a partial moderation in goods and prices in overall inflation, driven by slowing demand and rising supply. So we're starting to see a little bit of potentially maybe easing down the road, but we still think it's going to be high for a while. So in addition to reduced spending on goods, Goldman also expects the service activity to rebound. Okay, on this chart here, what we're looking at, we're tracking the sentiment of the Federal Open Market Committee members. So that's the Fed, and they're the ones that determine monetary policy, and they determine rates and tapering and easing and all that. So if we look at the blue line, it represents their projection for the Fed funds target rate. And this is from their December 15th meeting of last year. And it's really well above the trend line, which represents their projection for the Fed funds rates following their Open Market Committee meeting from September 22nd, 2021. So what we're seeing is an increase in where they think the Fed funds target rate is going to be, which just, again, reinforces that the Fed believes that they're going to have to raise rates to rein in inflation this year. So I think that theme, which started last year, is really going to continue this year. Goldman estimates that the interest rates, they're bound to rise in the U.S. and developed markets. So, I think that's no surprise there. That's something that we're definitely looking at. It really is how the markets and economy going to react to those rising rates. And this one here, this is an LPL research slide where it shows that 2021 was the only year since 2014 that the S&P 500 index achieved a record high in each month of the year. So that's pretty interesting to show how strong 2021 was as a year. And officially, in 2021, the S&P 500 set the second highest number of new highs with 69 for the year. So it was really a good year. And the blue bars in the graph, what they do is they represent the number of months that the S&P recorded a new high during the year, which stretches all the way back from 1928. So now the question lends itself. We had a great 2019. 2020 was the crazy year where we saw the really big drop in March and then a comeback for the rest of the year. The question naturally is it realistic to expect that this will happen again in 2022, given that inflation is running hot and then the Fed is preparing to tighten? So, we talked a little bit about growth expecting to slow in the second half of 2022. The projections are still it's going to remain strong in the near term. So even though that, December 15th, their announcement that tapering would be accelerated, the markets actually finished the end of the year strong. Now, there hasn't been a good start to this year. Based off of that, was also some other risks that we'll talk about. I think, the Omicron variant of COVID and really some of the uncertainty around some of these variants and what's going to happen is part of it. There's some geopolitical things, and we'll look at some of the risks that are out there. So, just overall, I think the market continues to display high confidence in recovery. So now, naturally, with what's happened this year, there are definitely some concerns out there. But if we look at some of the risks, we talked about COVID-19. I think one of the things that was uncertain for last year was, we got to a point where it looked like we were overcoming Delta, and we were getting to the point where we were going to have the reopening, and we'd stay reopening, and we'd put the virus behind us. Well, we saw over December, over the holidays, that maybe that's not going to be the case, and maybe we are going to be dealing with some more variants that keep the COVID as a pandemic and doesn't allow it to transition to like an endemic like the flu. So there's that. There's a fiscal drag. So I think the fiscal support that the U.S. and the Fed has put in place since the COVID started, I think they've communicated that they are going to taper that, and it's not something that can go on forever. So we have to. I think one of the concerns is, how is the market going to react to that? There's China, which has been a concern for a while, and they have some property sector issues on their side. They're regulatory. They're always coming up with regulatory restrictions, especially in tech and education. And then there's always the geopolitical tension that there is with China and the U.S. Inflation, we've talked about. I think that we'll continue to see inflation go up. Last year, the Fed was having a tone where inflation was transitory and it was temporary. And, I think towards the end of the year, they finally admitted that we probably are going to see inflation for a while. And now the question is the uncertainty of how long is that going to be, and how high is that inflation going to be? And then inflation's cousin are interest rates. So, we could see with interest rates going up, that's going to affect everything from how much money the U.S. itself has borrowed, but also things like mortgages and how is that going to affect the housing sector, or some of the riskier assets, which higher interest rates tend to scale back some of the growth assets, which we've seen. Some of the higher growth, whether it's in the tech or the biotech phase, have taken more of a hit over the past month than some of the other types of investments. And then there's also the elections. Going into a midterm election year, not just here, but also in some other countries, we don't know what's going to happen. The political spectrum has been, there's been high tension with it for a while now, and it doesn't seem like any of that's coming, will ease over the near term. And then finally, the unknowns. So you never know what's going to pop up. There's the unknowns, and then there's the knowns, but uncertainty with them. So, I think that's part of it as well. So here are the key takeaways for the start of this year. So I think there is strong, but we might see slower growth towards the end of the year and into the mid of this year. Inflation is probably going to get worse before it gets better. We are going to see tighter U.S. monetary policy. It's probably too early to de-risk, but you just have to be realistic with everything that's going on, especially everything that's happened over the past couple of years. Like I'm a proponent of managing risks, and risks are, they're usual. There's a lot of them, but they are manageable. All right, so let's get into some asset class views and forecasts. All right, so here LPL Research, they note that in the previous 6 rate hike cycles, beginning in 1983 and covering 87, 94, 99, 2004, and 2015, the S&P 500 had gained an average of 9.5% during the 6 months prior to the first rate hike. So we have no idea what's going to happen when rates hike, but one of the things we can look and see, how is the market or how's the economy reacted previously to rate hikes, knowing that this time can obviously be different than that. And the chart to the right, it breaks down these numbers even further. So what it does is it shows that cyclical and value type assets or type stocks, they performed better during these inflationary periods or these rate hike periods. So the top 3 bars here, which show the 3 areas that performed the best, were materials, industrials, and energies. So these were the biggest winners with returns between 10 and 15% in those rate hike environments. And we definitely may be seeing the signs of a shift from growth towards value and defensive sectors. Analysts at Morgan Stanley believe that the Omicron variant, coupled with the Fed raising rates, has kicked off this slowdown in growth, and that actually started in November. So we can see on the chart on the right that defensive stocks, represented by the blue line, they've taken off since late November. They're beginning to outperform growth and secular growth. Value, which is in green, that appears to be trending upward as well. And that's kind of the things, some of the things we look at when we're managing a portfolio are, where are the trends, where are the shifts in it, whether it's a sector or whether it's an asset class, or in this case, whether it's strictly just growth, between growth and value. And, one of the things we point back to is, the aftermath of 2007, 2009, inflation really has struggled to reach the Fed's 2% goal. So, this financial experiment that we're in, it didn't just start during COVID. We've essentially been in this really low rate environment since 2007, 2009, in that financial crisis that happened then. So if you look to this graph here, which is from Capital Group, what seems to occur is that stocks suffer towards the extreme ends of inflation or deflation, and that a small amount of inflation is actually good for companies, as it allows them to raise prices and it helps their profit margins. However, when inflation climbs 6% or higher over a 12-month rolling period, stocks tend to suffer. So we can see that with the light blue bar on the charts, which are those far right bars, which makes sense because higher inflation means higher input costs, higher loan costs, and then also limited pricing power. But on the other hand, we can also see that when inflation is too low or below 0%, that's to the far left, that stocks performed actually even worse. So the one thing you can take away from this graph is that stocks and bonds usually manage to do well even in medium or high inflationary periods, which in this case is like that 2% to 6% range, which is in the middle of the chart. And Goldman believes that the point where inflation begins is just as important as where it's going. So they find that inflationary environments, which start from positive inflation levels, tend to result in negative returns for both stocks and bonds, as higher input costs will hurt profits of companies and reduce expectations for future growth. Okay, so this here is Goldman's asset view classes. So what you can see is they see more attractive asset classes being U.S. and European equities for both shorter and long term, and they actually like some of the international, specifically the euro assets, over a longer period of time. They believe the least attractive asset class, it's U.S. government fixed income. And when you look at that, if rates are going to go up, what that means is the price of U.S. government fixed income would be negatively correlated with that. So as rates go up, the value or the price of those fixed income bonds or treasury notes go down. So that's one thing to consider. Now they prefer equity over credit or equity over fixed income. They also expect returns from longer duration bonds to be negative. And that makes sense also. As interest rates go up, you wouldn't want the risk of having a longer term bond, even though the interest rate that you get on it may be a little bit higher, but you're going to be holding that for a long time. And with the uncertainty of how high rates will rise, you don't know really, if you have a bond that's kicking off, let's say 4% or 5% interest, that sounds great. But what if interest rates go up to 8% or 7%? Now you're stuck with this bond when you can get a new one for that kicks off a lot higher interest. So you do want to be careful with some of your longer term maturity date bonds. In the top row here, we see that Goldman forecasts the S&P 500 to raise by 8.2% in the next 12 months. They project the 10-year treasury to rise by 50 basis points to 2% in the next 12 months as well. Now, predictions are always great, and we could probably find another Wall Street company or financial institution that'll predict something different. So it is good to see where predictions are, but some predictions will vary very widely from what Goldman's predicted here. All right, so let's take a little bit of look at some portfolio trends for 2022. And if we looking at the capital allocation side of the equation, it really doesn't provide enough information to understand what's truly going on in portfolios. So you really want to look at the capital side, but also the risk allocation as well with it. And then, they put a quote in here about don't put all your eggs in one basket, which if anyone's a Don Quixote fan, Miguel Cervantes was famously warned that. And, it's especially for this time where, you really don't know what lies ahead. There is some uncertainty out there. It's probably pretty sound advice not to do that. So in section 2, we'll talk about 10 things to watch for this year. So some of the things, about what is going to happen with economic growth, and probably the fastest pace of recovery is already behind us. The global GDP, it's likely to grow 4.5% in 2022, which is over 1% more than what was its potential or what was projected. So they predict that the first half is expected to be stronger, and then we'll see some, with those hopefully improving virus conditions, that we will finally get to an full economic reopening, some pent up consumption where people will be traveling, spending money, and then rebuilding of the inventory. I get a lot of questions about how does geopolitical events impact the market or someone's portfolio, and I think political uncertainty definitely has a noticeable short-term effect on the markets. And this is a midterm election year, so we may see some election-induced uncertainty. I did a podcast episode about how elections affect the market. I think the big one right now that I'm getting questions about is, the conflict between Russia and the Ukraine, and what happens if that spreads. I think over a longer period, the geopolitical events have less of an impact than some of the monetary policy, and then it ultimately leads back to corporate earnings that drives a lot of the market. But yeah, of course, some of this geopolitical events are concerning, especially if there is a contagion effect and it spreads to something as worse, as catastrophic as a world war, which some people are saying, but then you have other people on the other side who think that a lot of this is overblown. Goldman believes that developed market equities will make a comeback in 2022. Now, the thing with this is that people have been saying, U.S. has been on a run. U.S. Equities their valuations are really stretched, they're really high, and there's value at other places. And I'm a believer in that as well. The problem is that people have been saying that for a while, and it hasn't really come to fruition. But they do estimate that the indexes, the stocks, which is the European index, they believe the equivalent to the S&P. They believe that it's going to outpace the S&P 500 by a couple of percentage points in over the next 12 months. And they believe in a longer term that they expect a flatter equity market with lower returns, a little more volatility, and some less regional variations on it. So I think I've been hearing that as well for years as well too. Don't expect the same equity returns that we've been seeing, and some of the predictions sound great, but some of them haven't come to fruition yet, and maybe they will, but we'll see on that. So here we can see Goldman's predictions on where interest rates are going. We know that they most likely the Fed seems like they are committed to raising them this year. I think March, June, and September of this year that's corresponds to the Fed's 3 meetings in those months. That's probably when we're going to see it. So what they're predicting is a rate hike every other Fed meeting in 2022. But however, we're talking about rate hikes. Even with the 3 rate hikes, interest rates will still remain relatively low. So it's not, that, and I think that's part of, sometimes things get overblown one way or the other. Like in this case, we're talking about rate hikes, and the market, spits it up, and it doesn't like it because one, it doesn't like the uncertainty of it. But in reality, if you look at it from the actual specifics or what's happening, rates are, of course, they're really low. And raising rates is going to have an impact, but these are small raises. It's not that the interest rates are going from, the Treasury is going to go from 1.5% to 5%, or if you take out a 30-year loan, it's not going from 3% to 8%. But interest rate movements do have an impact. It's just really gauging kind of really what that impact is expected to be. The other thing, in addition to rates, people look at currencies. So the values of the euro and British pound, they're forecast to increase over the next 12 months, with the yen expected to decrease. And if you look at it, the US dollar has increased 6.7% year to date. So that has an impact on exports, imports, and really the increase or decrease of a country's currency really has, really lends to how strong they think the company's economy is. So I think we'll see foreign currencies diverging as, other central banks aside from the US, they start moving to fiscal tightening as well. Because usually what's happened is they follow the US's lead. So if the US is going through a monetary policy tightening, whether it's tapering and interest rate hike increases, we're probably going to see that in other countries as well. So Goldman, they don't really expect the underinvestment problems in the commodity sector to be resolved easily. So what they're expecting is that commodity prices are going to rise next year, but then will eventually fade. And this tends to that where they're predicting inflation, or where everyone's predicting inflation to go. And, we've seen commodity prices, astronomical increases or out of control. And really what they're seeing is that there is some issues with that and how inflation is impacting that, and that we might see continued problems with that. But over a longer term, it should taper or should slow down. Okay, now we're going to talk about some perspectives on risk and volatility, which I know that's what really is concerning to investors, because one, the volatility, right? You look and you can see your portfolio go from one thing to drop down to another, and it's extremely concerning. But you also have to look at it in the context of the risk that's in there, and what you should be thinking about when it comes to correlate your risk return, and then obviously your volatility that comes along with that. So the left hand side of this graph that represents the annual returns of the S&P, while the right hand side, which are those black diamonds, represent the percentage of time that the returns were higher than the average in that year. So it shows that the annual return of the S&P 500, it's typically the lowest in the second year of a presidential administration, which is bar 2 on this, with the S&P 500 returning 6% on average. So that's where we are this year. We're at year 2 of a presidential administration. And the year following midterm elections, it's generally the highest performing, which is up 16.8% on average, as the political tension and uncertainties from those elections have subsided. It's that theme that markets love certainty. They don't like uncertainty, and political uncertainty is just one realm of it. So going into a traditionally weak year for stocks, coupled with rising interest rates and record high inflation, along with rich valuations, we could see the continued volatility that we're seeing, that we saw or we have seen since the start of the year. So it's definitely something to watch, definitely something that's concerning. But these are average returns. It doesn't mean that it will hold true or hold this pace for this year as well. Okay, so Capital Group, they put a lot of emphasis on the fact that it is a midterm election year. They say this year, 2022, it's one of the most consequential elections in history, and they tend to highlight how political uncertainty does have a short-term effect on markets. So if you look at this chart, the trend in the chart here, it plots the average S&P 500 return in a midterm election year going back to 1931. So if we look at the black trend line, which represents the average returns for all non-midterm election years, it's saying that they perform about 3% on average better than midterm election years in blue, and then 9% in non-election years is where the returns are in non-election years. So they also suggest, which I guess it's true for this year, is that the first few months of the year, they're generally more volatile and uncertain, but the returns tend to recover in the later part of the year where there's more political uncertainty. So if this was just a normal year and the political midterm elections were the only thing going on, maybe you take some credence into what this is showing. But when we looked at that risk slide, there's a lot going on between viruses, interest rates, where we are in the economic cycle, that this is just one piece of the pie of what's going on. Interest rates, back to interest rates, they've been really low for a long time. So the big question is, how will markets react as they go up? And I think, we've talked about that a couple of times in here. And then one thing going back is that one of the pieces of statistics, it shows that the first 400 days of this current bull market, they're the best performing since World War II. And that's the green line that represents the run of the S&P 500 since March of 2020. So if you remember, in March of 2020, we had the big drop once COVID started and officially ended the bull market. And then very quickly, there was a start of another bull market. So I don't know if you want to, it's really an abnormal end and start of a new bull market. But officially that's what happened. So, the question is what, correction is, and bear market risk. It's when there's a drop of 10% or more. And I think one of the things that people don't realize is that this actually happens quite frequently. And this is, not, this is just normal economic cycle. It doesn't mean that specifically something had to cause this bear market or bear market or correction risk that's out there. So, there's bear market risk when, it happens quickly and there's a big drop, and then, we start that next economic cycle. And, if the correction risk, that's really looking at from March of the lows of 2020. And really, there've only been a couple other times in history where we've seen an index rally by at least 50% in a year. So there's no doubting that the past couple years have been, really abnormal in terms of everything going on. But, we have a pandemic that we've never seen before as well. So there were, and some, monetary policy or financial stimulus from the government that we've never seen before. So yeah, there are definitely concerns out there. But corrections and bear markets do happen. It doesn't mean that, I wish everyone that I talk to, I'll tell them, yeah, I wish the market would just go up in a straight line. But if you look at any chart, we know that doesn't happen that way. Okay, so here are some of the key takeaways given the current environment. The market, like we discussed, the market's really rallied since its low in 2020. Growth is expected to continue in 2022 as long as corporate profits are strong. So fourth quarter 2021 earnings season started last week. So we're starting to see some of the reports. It started with the financial sector. We're starting to see some of the tech sector report this year. And I think for the most part, they're pretty good. Although we are seeing companies hint at some uncertainty with COVID, with supply chain issues, and they're not sure how it's going to affect their 2022 earnings. And that's obviously concerning because, again, going back to the theme of the uncertainty, and markets do not like uncertainty. So even as the Fed prepares to tighten its monetary policy, financial conditions still remain favorable and interest rates are still low when you look at it. So I mentioned, we know rates are going to go up, but even if you look at it, the context of historical, they're actually still pretty low. And while inflation is high currently, I think, and this goes back to that last year and whether it's transitory or not transitory, the projection is that it will taper down towards the end of this year, and that some of these supply chain issues that we're seeing, hopefully they subside as well, and that the labor market does move towards full employment. So I think, we've seen some of the labor numbers come out and they've been good, although, I think there are some labor shortages in some areas, some sectors of the economy. If you look at it, the Federal Reserve, they've done a good job communicating its tapering plans to investors. And usually what's important about that is, the market doesn't like uncertainty. So they don't like, one meeting, the Fed stating X, and then the next meeting, they completely change and flip it and say, oh no, we're going to do Y. So I think the Fed has stick to its communication and has been consistent with it. It's really now just to see how the markets react. So I don't think the markets will be surprised when interest rates go up 3 times this year. All right, in the last section, we're going to talk about some bearish predictions. So not to scare people, but you always want to look at worst case scenarios or the negative scenarios, and with the reasoning of let's make sure you're prepared for those scenarios to happen. All right. So according to Jeffrey Gundlach, who's the CEO, and he's known as one of the most prominent analysts on fixed income, he's a little contrarian, and he doesn't think the U.S. economy is as strong as people have been making it out to be. He thinks that the stock market is going to be challenged when the quantitative easing pauses, and interest rates rise. So that's, really going back to that. We don't know what's going to happen. Well, Jeffrey Gundlach is one, for example, and thinks it is going to cause a problem. So when he says when we start seeing less stimulus in the economy, and when he says Jerome Powell, the Fed chairman, he's likely to double the pace of tapering to 30 billion a month. He thinks that Fed stimulus or the Fed bond purchases, they've really been what's supporting the economy. So he thinks it'll turn into some rougher waters, and obviously that tapering is ultimately going to lead to increased interest rates as well. One of the things that could be out there is the U.S. dollar declining. So and even though we've seen a 6% increase this year, we'd expected that the dollar would be strong last year, but again, Gundlach's long-term view remains bearish on the dollar. So he thinks that we're going to see a weak dollar in the second half of 2022 and even in 2023. And he thinks that's really because of the deficit problems in the U.S. And again, a weak dollar, similar, really forecaster shows a weaker economy in it. So, I think number 6 is non-U.S. stocks will start outperforming. If you look to how a lot of portfolios have been allocated, because U.S. large cap stocks have been shining, portfolios have been allocated a lot to U.S. large cap stocks, and not having that diversification may hurt if non-U.S. stocks do increase. Then I think number 7 about the economy starting to be further hit if 2-year and 3-year Treasury yields continue to rise, and this is simply it's going to be the cost of U.S. borrowing is even more, putting the country in a worse debt situation than it'll be in. All right, so to wrap things up, some key takeaways. The global economy recovery, although it may be slowing towards the end of this year, it's still intact. Equity valuations are high. They've been high for a while. Bond yields are low. So you just need to be selective with your portfolios moving forward. Washington, not necessarily your friend. I know the other thing we didn't talk about is that there is a pretty big tax proposal that's kind of hanging out there. It got started in 2021. It went through a couple of iterations. There wasn't enough support to pass it. It got tabled, and probably at some point this year, it's going to come out again. And that could have some wide-reaching impact to people. So I think it's one, we're talking a lot about markets, a lot about economy, a lot about portfolios, addressing the tax implications of some of these changes, looking at maybe some tax diversification, or how are there tax shelters out there, are definitely things to consider in it. So went through a lot here, and like everything, this was in general. We talked about this in general context. So you may have something specific about what's going on with you that you have a question about. So I'm happy to talk to you, talk or have a free consultation. You can book it at our website, bautisfinancial.com, or here's my contact info if you have any questions. So with that, Kira, do we have any questions?
We do. We have one question in the Q&A. With interest rates rising, should we stay away from short-term bonds? Any advice for short-term investments?
Yeah. So usually when you're in an environment where interest rates rise, if you're looking at it just from the fixed income perspective, short-term bonds are a little more appealing than long-term bonds. So with long-term bonds, they react more to interest rates rising because, let's say you're buying a bond that either has like a 10-year maturity or even longer, like a 30-year maturity, and the interest rate may look good on it. Like I said, you may see something for like a 3% or 4% interest on it. But what if interest rates rise? All of a sudden you're holding something for 4% that you have, essentially a maturity date of the next 10 years, 20 years, 30 years, where there might be if you had that access to that principal, you could purchase a bond where, maybe for 8% or something higher. Whereas a short-term bond, so let's say you have a bond that matures in 1 year or 2 years or 3 years, what would happen is, that bond matures. It's not paying as much interest rate as a longer-term one, but you get your principal back, and now you can deploy it into a bond where the interest rates are higher. So one of the strategies we look at, and sometimes makes sense, is called a fixed income bond ladder. So that's where you're adding bonds with different maturity dates. So let's say you have the bond ladder is constructed of bonds that mature in 2022, 2023, all the way to 2030. When your bond matures from 2022, you get the principal back, and then you purchased a bond at the end of the ladder. So a bond that matures in 2031. And what this does is it gives you a little bit of a hedge if interest rates do go up, because some of your principal is coming back every year and you're purchasing at the end of the ladder at a potentially higher interest rate. Anything else?
Great, thank you. No, that's it for the chat today. That's it for the Q&A today, sorry.
Perfect. So thank you, everyone. And like I mentioned, if you go to bautisfinancial.com/learning center, you can see, this replay. You can see any of our previous replays. And also you can register for any upcoming webinars that we have. So thanks, everyone.